All right, so let's take a look at your Chapter 3 homework problems. So this is problem number 1. And on problem number 1, we're looking at that revenue, those revenue rules in terms of what needs to be recognized as revenues. So we got the following transactions are February activities. They are, looks like indoor golfing lessons is what they do. And they want to know if revenue is to be recognized in February. So we got A through E. So let's start with letter A. Says they collected 15,000 bucks from customers for lesson services given in February. So they've earned these because they've actually performed their obligation. So all of that would be revenue. Next one, they sold a gift card for golf lessons for $150 cash in February. Well, a gift card is more of a future obligation. They haven't earned anything yet. So none of that would be reported as revenue. Next one says they received $4,000 cash from services provided on account to customers in January. That's just a collection on account. That revenue has already been recognized in January. So for February, it'd be 0. And then we've got the collected $22.50 in advance for services to start in June. That's just a prepayment. All that would be deferred revenue, so nothing. Last one says you billed a customer for services that were provided in February. So all of that amount should be recorded as revenue. All right, that's number 1. Let's check out number 2. And this one, we're looking at when expenses should be recognized. We've got, again, it looks like this one is swing hard, same thing. It's the indoor golf. So it looks like they paid $47.50 to its golf instructors for the month of February. Of course, that's just going to be your monthly expense. That's a salary. That's going to be all recognized in expense. You've incurred that. That should be matched in February with February's revenue. They paid $17.50 for the electric used in the month of January. Of course, all that expense would have been recognized in January and not in February, just that you paid it the next month. So none of that would be recognized in February as an expense because, again, you've already recognized it. And then should you receive the electric bill for $800 for February to be paid in March? Well, even though you haven't paid it yet, you have to accrue it. You've incurred it. So that way, all of that should be reported as expense in February. All right. Number 3. So in this one, they want you to go ahead and write these into a journal entry. So here's how you'd recognize cash revenue. You just debit cash. This is at $15,000 credit service revenue. On B, because it's deferred revenue, but you've got the cash, you have to debit the cash, credit deferred revenue. C, you've got cash coming in from your credit customer, so that's just taken from your accounts receivable. So debit cash, credit accounts receivable. D, you collected $22.50 in advance. Again, this is a prepayment, so it's a deferral, just like part B. So debit cash, credit deferred revenue. Remember, that's the liability. And then E says you billed a customer, so this is going to be an accounts receivable because you've earned it. So debit AR and credit service revenue. All right, that's number 3. Now, on your expenses, let's check out these entries. Again, this is just your normal expense account. Whenever you pay your expenses, so you debit your wages expense, $47.50 credit cash. Next one, you're just paying your liability. So you're debiting accounts payable, crediting cash. Well, this is from the previous month. And the last one, you're accruing it. So you're going to be debiting an expense account and crediting an accounts payable because you've incurred it even though you haven't paid it yet. All right. Number 5, more revenue problems. So let's check these out. In this case, we've got, this says for many businesses, this condition is met at point delivery. So in this one, we just have some individual independent companies. This is not like one long problem. So each one of these, you have to take them one at a time. So we'll start with the first one. And they want to know if revenue is to be recognized in the month of September. First one is just going to be a stock sale. Remember, this is common stock. This is not under retained earnings. So this is investments, not revenue, so nothing. Next one says they received $20 million cash for the 5-game season. Nothing's been played yet, so all of that is deferred. You don't start earning the revenue until you've actually played the game, so nothing. Once they play their first game, you got to figure out how much you would recognize. Well, really, you just take the $20 million cash, and you just have to divide by your 5. So just basically 20 divided by 5 would give you 4 because it's a 5-game season. So 4 of that would be actually considered earned after they played 1 game. Next one, they simply signed a contract for the construction of a warehouse. They got money in advance, but they actually haven't started to build anything just yet. So all of that's deferred. So nothing is recognized. Next one says they received a total of $1,800 from subscribers. Again, those are all prepayments. So that's still a deferral. You haven't recognized anything yet because you haven't earned it. So that's nothing. The last one, you went ahead and you actually sold a cell phone plan. This is a actual point of sale delivery. So all of that $100 would be recognized as revenue. And again, those are my comments. And of course, you can look at their explanations as well. All right, that is number 5. Now we'll go with the expense side, see what we talk about, what gets incurred. So this one, we pay the salespersons and commissions related to December. Of course, and this, you have to watch your dates. We're looking for expenses to be recognized in January. So the first one, we've already recognized all of it. We're just paying them off. We probably would have accrued it. All this expense would have been recognized in December. So nothing is recognized in January. You're just making the payment. Next one, it says they're paying their salespersons $4,200 related to January. So it's a January matching. So all of that $4,200 will go into January, even though you haven't paid it yet. That's what you've incurred, not what you've paid. Part C, the City of Omaha hired Waste Management to provide trash collection services. This is in January. They paid $12 million for the whole year. From their standpoint, really, you just take 12 million divided by 12. So 1 month, every month, you can record an expense. So 12 over 12 would give you $1 million for the month of January. And then, of course, in the month of February, it'd be the same thing, another $1 million. Next one, they paid $10,000 in advance for refundable airline tickets. The first game will be played in March. Because it's in March, nothing will be incurred as an expense just yet. All right, next one, so you have a community college, employee work 8 hours, $15 per hour. Payday is not until February, doesn't matter, they've earned it. You have to record that expense because you've incurred it. So you have to take that $15 times 8 to get that 120. Next one says you paid $3,600 for a fire policy. This was January 1, beginning on February. So you have to take that $3,600 divided by 12. That's how much expense would be recognized in January, which is $300. Last one, you got a farm equipment. They received a phone bill of $230 in January. Well, so that's an expense, even though you don't pay it until the next month. You still have to report that as an expense. All right, and then down below, of course, you can see these calculations I just commented on. All right, that's number 6. Now we'll check out how some of these transactions would affect your accounting equation. So part A, you got cash sales. Notice you've got 49,000 there, and that's going to, of course, increase your asset and then increase your sales revenue. Part B, you've got purchase supplies on account. We know that's an asset, so increase the 3,000 and increase accounts payable. C says you borrow $58,000 on a long-term note, so you're going to increase cash, increase that long-term note. D says you purchased more equipment on cash, so again, you're going to be increasing. This was for 18.6, so you're going to be increasing equipment, decreasing cash. E says you incurred some selling expenses. You paid 2/3 in cash, and the rest is on account. So that 27,000, we know that's going to come out of equity. And then, of course, we've got the cash, and then the rest would be going on. Looks like it's going to be accounts payable right here, this 9,000. Last one says you paid the rent and also paid for the next month's rent. So you've got the $9,400 coming out of cash. And of course, you've got the prepaid rent. And then the other $4,700 would just go right to rent expense because that's going to be for the current month. All right. Then I think the next question they want is simply how much of this is income. Well, if you look at what would relate to income, you've got 1 revenue, 2 expenses. You just net these together. And then that's how they would come up with the net income, which is 17.3. All right. 2 more. On this one, again, we'll look at the journal entry aspect of it. You can check these out. And then I think the question again is how much is your preliminary net income? And then you can see as you go through these, again, I'll comment on these. Some of these are starting to be repetitive, but here's your borrowing where you're debiting cash, crediting notes payable. You bought some equipment for cash, debit equipment, credit cash. You bought supplies on account. debit supplies, credit accounts payable. D is just from repair and maintenance. You debit your expense, credit cash. On letter E, this was prepayment, so you receive money in advance, so it's a deferred revenue item, debit cash, credit deferred revenue. On letter F, it looks like this was an actual cash sale, so debit cash, credit service revenue. G is more deferral, where you got money but you haven't earned it yet, so debit cash, credit deferred revenue. And then let's see, number 8, you're simply paying on account by debiting accounts payable, credit and cash. And the last one is just your salaries expense journal entry, which again, you've seen that one before. So at that point, look for all your revenue accounts. You got, looks like we've got, there's a revenue, one revenue account, which is 76,000. And then you've got expenses of 22 and 18. And if you net those, that's how they're going to get problem number 2. And this is how they're coming up with their preliminary net income by taking that revenue and then subtracting out those 2 expenses to get the 36,000. All right. That would take care of 8, and then I believe this is the last one. And the thing on this one, there's a lot of entries they just want you to kind of go through. And on this one, I won't comment on everyone because a lot of these at this point, I believe you've seen every one of them. There's nothing new at this point. Just make sure you follow the right account names. Notice here's some supplies on account. You got a credit sale. You're paying some money on account. You got advertising expense. You bought some equipment for cash. Here's another salaries expense. You're collecting on account. Looks like you bought some land with cash and the rest it's a loan. You issued more stock for cash, and here's a credit sale. And then the last one is you have utility bill where you haven't actually paid it yet. So again, practice these. Make sure you get the dates in. And I don't think they want you to do anything else on this one other than practice entering these journal entries. And I think that would take care of my comments on the Chapter 3 homework.